Hey, I'm Tim Bratz, and let me cut straight to the point. Over the past 4.5 years, I've built up a commercial real estate portfolio worth over $270 million. So I built a lot of equity in a fairly short period of time. How? By buying value-add apartment buildings. You buy value-add apartment buildings for the cash flow, for the tax-free refi proceeds, for the equity that you're able to create, and the ongoing appreciation. That is how legacy wealth is built. I want to teach you how I do what I do. I do not do deals like traditional syndicators and how all these gurus teach you to go and buy retail price property and hang on to it for 5 years, 7 years, speculate that it will appreciate and be able to go and sell it in the future at some speculated price point. That is not what I'm going to teach you to do. I'm going to teach you how to buy off-market, direct-to-seller, wholesale priced apartment buildings, create appreciation by forcing the value add, and then be able to refinance out your investors in a pretty short period of time, typically 12 to 24 months. So that way you can take all the chips off the table, only have house money in play, and hang on to these properties, let the tenants pay down the principal, let the property appreciate over time, and now your back's not up against the wall where you have to sell it in 5 years or 7 years. You can hang on to these for 10 years, 20 years, 30 years or longer and build legacy wealth that way. So before we begin, let me tell you about who this is for. There's a lot of people that reach out to me and come from social media and say, hey, Tim, can I sell you a deal? Can I buy a deal from you? Can I passively invest with you? Can I pay you to coach me or mentor me on how to do this stuff? What I do and how I do it is primarily for people that fall into one of two categories. The first is people who they want to be real estate investors. They want to be active operators and go out and find deals, operate deals, oversee the project management and the renovations and property management and all those different aspects of the actual boots on the ground operations of being an active real estate investor. That's phenomenal. Maybe those people have those skill sets, but they need access to a balance sheet. Maybe they need help with qualifying for loans and sponsoring loans. We can bring that value. Maybe they need help with raising equity or raising cash for the down payment, or maybe they just need somebody to hold their hand to make sure that they don't fall forward, because just as much as buying apartment buildings can increase your net worth, one bad deal can take your legs out, and you need a good mentor, you need a good coach and somebody to hold your hand through that whole process, and that's one of the people that we partner with. The second type of person is somebody who says, Tim, I love what you're doing, I love the value add play, I love the asset class that you're in. My problem is I just don't want to do the work that you're doing, right? And that's okay, because I have money or I have access to money. Can I just deploy it with you in a passive way? And absolutely, we can deploy it into quality projects. We can make sure that the money's safe and stewarded in a very safe way. And that allows them to go back to their primary business and make more money, generate more revenue in their primary business without having to get in the weeds over here, right? They can go make money, passively invest it in projects, earn double-digit returns, earn tax advantage returns, and build long-term wealth and long-term equity in projects with us. I want to talk to you guys about the benefits of investing in commercial real estate. Number one, the scalability. I love being able to go out and negotiate with one seller instead of 40 sellers, right? If I'm going to buy a 40-unit apartment building, I talk to one person, not 40. I go to one site, not 40. I look at one roof, not 40. I go and look at one foundation, not 40. The contractors and rent collection and property management only has to go to one space, one location, not 40 locations. It's a lot more scalable. You get insurance on one location instead of 40 locations, right? It's a lot more scalable. You can do a lot more. It's actually easier to manage a bigger deal because of the scale that apartments have versus single family houses. Number two, there's more equity in apartment buildings than there is in single family. Here's what I mean by that. You're talking about bigger numbers. You're adding zeros onto all the values. So when you're going out and flipping houses, or at least when I was flipping houses, it was hard to bring in all these different A players and carve up 10, 15, 20, even $30,000 worth of profit amongst 3, 4 different people, right? There's too many hands in the cookie jar. When you're doing apartment buildings, you're talking about hundreds of thousands, if not millions of dollars worth of equity in any given deal. So now you can partner up with different A players and bring on somebody who's phenomenal at project management, bring on somebody who's phenomenal at property management, somebody else who gets involved from an asset management standpoint or fundraising standpoint or loan sponsorship standpoint. All these different players can be involved, and everybody It can justify everybody's time because there's so much more equity in a deal. You might have heard me say before, I'd rather have 25% of a watermelon than 100% of a grape. Does that make sense? Meaning there's a lot more juice in the squeeze of 25% of a watermelon that's this big versus 100% of a grape that's this big. And here's the other thing, it's just more fun, right? I don't have to do 100% of the work and be the mule that I was when I was investing in single family. I can be more of a magician over here, focus on the things that I'm really good at and the things that I really like doing, and not have to do those other parts. I can partner up with people where that's their core competency, that's their core ability, where they can focus on those things. I can focus on what I'm good at, and guess what happens? 1 + 1 = 3 in that equation. We can do more together. Number 3, residual income. I think everybody gets involved in real estate because they have this allure of residual income, passive income, that mailbox money that we all hear about, right? And we all want it, but then we all fall into this transactional trap of trading our time for money. Meaning, when I first got involved in real estate, I thought I had to go and stockpile a bunch of cash in order to go and invest in passive income producing assets. Not the case. But I still went over, I started wholesaling, I started flipping houses, I was doing all this transactional stuff, and it was just a high paying job at the end of the day. Buying apartment buildings and commercial real estate, there's ways that you can take fees on the front end that cover all of your expenses, right? You take a fee of 1%, 2%, 3% on the acquisition of a commercial property. And if you're talking about a multi-million-dollar deal, you're talking about an acquisition fee that's in the hundreds of thousands of dollars. That keeps the lights on, that keeps food on the table, takes care of your overhead, right? And at the same time, you're actually buying assets that produce passive income, that produce residual income. Every single month, on the first of the month, my tenants pay rent. If I have a 100-unit apartment building and the average rent is $800 a month, I make $80,000 the first week of the month. That money will go to operating expenses, that money will go paying debt service, and that money will go into my pocket. I can spend all of that money. You know what happens on the first of the next month? They fill up my bank account again. I can spend all the money again. You know what happens in the first of the following month? They fill up my bank account again. That's residual income. That's passive income. Well, it's passive if you have the right people in place, right? You got to have a team, and you got to have property management partners. You got to have asset management partners. You got to be able to understand how to operate a team and run a team of people. It's not as difficult as you might think. So number 4, let's talk about the tax advantages of commercial real estate. One of the things you got to understand is that since the beginning of time, or beginning of civilization at least, wealth has been measured in land ownership. And the landlords have always been the ones who made the laws, made the rules, including the tax laws and the tax rules. So commercial real estate investors are way better off and have way better tax advantages than any other business owner out there. And I'll give you a couple examples. One is depreciation. You know, we all heard of depreciation. Property values over time go up, yet the tax law allows us to depreciate the value of the buildings and of our properties over time to offset the income that it produces. It's wild, right? But it's one of those tax benefits that landlords and landowners have. Another one, 1031 exchanges. When you sell one of your properties, and let's say you buy an apartment building and you're into it for $1 million, you sell it for $1.5 million, you should have to pay taxes on $500,000 there, right? What the tax law allows you to do is roll that money into another property, and you can buy another property, a bigger property, maybe in a better area, and you can kick that can down the road, meaning you don't pay any taxes on that $500,000 gain until you actually sell the final property down the road and you realize that actual income. If you keep on selling and trading up and trading up and trading up over your lifetime, you know what happens when I pass away? My kids inherit my properties, and the tax liability is reset at whatever the value is at the time of my death, and they never pay taxes on that. It's one of the reasons why the wealthy grow wealthier over time, right? And why you can create that generational wealth. Another thing, tax-free refi proceeds. One of the main reasons that we do this, that I have the business model that I have, is because I'm able to buy an apartment building at a low value, at a low basis. I'm able to renovate it, and then I'm able to put good management in place, good tenants in place, and I've been able to increase the value of that building so much that the bank is willing to give me a new loan. So I might be all into a property for $6 million that's worth $10 million. The bank in 12, 18, 24 months from now is willing to give me a 70% loan to value loan, meaning they're willing to give me $7 million on a $10 million valuation. With that $7 million, I'm able to pay off my acquisition loan, I'm able to pay off my equity investors, and then there's still $1 million of non-taxable refinance proceeds in that property. I'm able to then carve that up amongst myself, the joint venture partners, and our equity investors, and it's non-taxable money. One of the other tax advantages is long-term capital gains. If you go out and you have a job and you're selling businesses and flipping businesses and doing some things like that in a time frame of under 12 months, even including real estate, you're taxed at whatever your earned income tax bracket is that year. You're paying normal income taxes on that. If you own that property for over 12 months, it's reclassified as a long-term asset, so you only pay long-term capital gains. If you're in the highest tax bracket between state, city, and federal taxes, your earned income tax bracket would probably be somewhere around 50% of your income is going to taxes. So if you can reclassify to long-term capital gains, right now, I think the long-term capital gains tax bracket is right around 20-21% for the highest tax bracket. So there's some massive benefits to recategorizing your income in a way where it's not short-term income, it's long-term capital gains, and only through business ownership and real estate can you do that. The fifth benefit to owning commercial real estate is building legacy wealth. It's what I live by. It's why all my company names, my investment fund's Legacy Wealth Fund, right? My education platform is the Legacy Wealth Education. My podcast is Legacy Wealth Show. My investment company is Legacy Wealth Holdings. I believe heavily in legacy wealth. And the way that legacy wealth is created is by buying assets that you can provide enough value for other people that they're willing to pay you for that asset. And they make payments to me every single month on one of my rental properties that cover the operating expenses. It actually pays down my loan and my investors, the tenants do, and puts cash flow in my pocket on a monthly basis. Over the course of time, that property appreciates. Over that course of time, the principal pay down on that loan is so significant that 20, 25, 30 years from now, depending on the type of loan that I get, that property is owned free and clear. And values have gone up so much that I've created legacy wealth. Millions and millions, if not tens of millions, hundreds of millions of dollars, maybe billions of dollars of equity in these properties over the course of time. It's by buying assets where you create enough value for other people where they're willing to pay you for your asset, and they pay your bank loan, they pay your operating expenses, they put cash flow in your pocket, and you're able to generate massive wealth over time and hand it off to your kids. Change your family tree forever by doing this type of business model. All you have to do is buy assets. Buying commercial real estate, what in my experience has been the fastest way to generate that legacy wealth. I want to go through some case studies with you guys on some deals that I've recently done. I have a couple apartment buildings, I have a self-storage facility, and I have an office building that I bought. So let's dive into some deals. Here's a case study on a 216-unit apartment building I purchased just about 8 months ago. This deal actually came through a Commercial Empire student, somebody who came out to one of my events and wanted a joint venture, sent me this project, and we ended up saying, hey, we'd love to be a part of it. We actually brought the financing, we brought the equity, the down payment money, and we're doing a lot of the asset management on the back end. Our joint venture partner found the deal, they're doing all the project management, and there are boots on the ground locally to the project in case somebody needs to meet with an insurance adjuster or somebody needs to meet with the building department. They act as that representative for our company. So let's dive into this one. 216 units, this is in Oklahoma. It is about 2 hours north of Dallas and about an hour away from Oklahoma City. It's in an area called Lawton, Oklahoma. We bought this 216-unit apartment building for $6,170,000. We put $1,193,000 of capital improvements into it. And we had some closing costs, some carrying fees of about $186,000. So our total all-in cost on this 216 units is $7,550,000. Again, we're about 8 months into this project. All the renovations are done after 8 months, and now we're just in the lease-up phase. So as we're going through this lease-up period, we're getting the rents that we projected, the management's on point, the expenses are exactly what we projected. Actually, they're a little bit less than what we projected. And our net operating income, once we get up to that 90% occupancy rate, will be $737,000 annualized. So that puts us at a cap rate based on our all-in cost of $7.55 million. That gives us a cap rate of 9.8% in today's market. I know a lot of people out there are saying that you can't find deals in today's market. You got to buy something for a 5% cap rate or a 6% cap rate. It's not realistic. 8 months ago, I bought this 216-unit apartment building in a solid B-class area, and my cost basis, because I was willing to get my hands dirty, along with my joint venture partners, we were willing to roll up our sleeves and do the work. Our cost basis is so low that it creates a 9.8% cap rate for us through one of these value-add projects. So what does that do? At today's valuations, that's going to put the stabilized value in that market at $10.54 million. So we've been able to create $2.99 million of equity in just 12 months of owning and renovating and stabilizing this apartment building. Now we're going to be able to go back to the bank at that 12-month time frame, and they'll give us a new loan amount of close to $8 million. Probably about $7.9 million is what we're kind of projecting right now based on where the rents are falling. So with that, we'll be able to take refi proceeds off the table of $360,000. Pay back our short-term acquisition loan, pay back our equity investors, take tax-free refi proceeds off the table of $360,000, and have a cash-flowing asset that our tenants are making rent payments to us every single month that covers our operating expenses, covers our debt service, and puts nearly $20,000 a month of cash flow in our pockets that then we carve up amongst our joint venture partners, our equity investors, and my own team. $213,507 is what our cash flow projections are expected to be on an annual basis from this one property after everybody's gotten their money off the table. That is how legacy wealth is built. A lot of people are saying that there's not deals out there on the market right now. The reality is, yes, there are. You just got to swing the bat if you want to hit a home run. This deal is a 35-unit building that we came across on the MLS. And it had been passed over. It's been on the market, overpriced for the past 3 years. And I came across it. I told my acquisition guy, hey, let's make an offer on it at a number that makes sense for us. It was pennies on the dollar of what the asking price was. We went in at $500,000 on an office building that was listed for 7 figures, and the seller actually took our offer. So we went in, I think we actually went in a little bit lower than that. We ended up settling at $500,000. But we're buying a 30,000 square foot office building for $500 grand. That's less than 17 bucks a square foot, which is less than what you could even build this thing for. Now we're going to renovate it. We're going to put about $400,000 of capital improvements into the property, and that's, flooring, paint, fixtures, making sure that it's clean, safe, and functional for our office tenants, and it's a good place for them to come and work. And then there's probably about $50,000 of closing costs and carrying costs on this. So we're all into this thing for $950,000. We're 12 months in. We bought it at 30% occupancy. We totally renovated it, and we're up to about 65% occupancy today. And we got a big push on marketing to get the final about another 20-25% added into occupancy to get us up to that 85-90% mark. Here's what stabilized projections look like at 85% occupancy. $162,000 of net operating income. So this property will generate enough revenue to cover all the operating expenses and still net us $162,000. If you divide that out based on our cost basis of $950,000, that gives us a cap rate at our cost basis of 17.1%. People are buying properties right now, commercial properties, at 5% and 6% cap rates. They're saying no deals are out there at a 9-10% cap rate. This is a 17% cap rate I bought in the past 12 months. That's at a very conservative valuation. The property will be worth about $1.91 million. That means we've created $960,000 of equity in a single small deal in just 12 months' time. That'll give us a new loan amount of about $1.337 million, which means we're going to be able to take out refi proceeds of $387,000 on this project. So think about this. We've purchased a property, renovated it, marketed it, put quality tenants in place, put good management in place. We've created almost $1 million of equity, taken nearly $400,000 of refinance proceeds tax-free off the table, and it still generates $65,000 a year in cash flow after operating expenses, after debt service. We've been able to build up a significant amount of equity for ourselves and our investors in this deal, kick off cash flow in perpetuity, let the tenants then pay down our principal note on this property. And guess what happens 20 years from now when we have this thing fully paid off? We have millions of dollars of equity in the property for myself, our JV partner, and our equity investors. That is how legacy wealth is built. Check out this deal that I just bought in North Carolina. 300 self-storage units from somebody that came out, one of my coaching students, just about 6 months ago to one of my events. He came out 6 months ago and wanted to get into self-storage. I actually never have been into self-storage until this deal. It was my first self-storage deal. But he was all about it, knows the industry, knows the asset class really, really well, and he knows how to go out and find these deals. He knows how to operate them. What he didn't have access to was cash and loan sponsorship. Let me give you the specs on the deal. We bought the 300-unit storage facility for $1 million. It was in pretty good shape, just needed some cleanup and some automation done. So we invested about $72,000 into that. Closing fees and carrying costs were around $78,000. So our all-in cost on this was $1,150,000. We purchased this just 60 days ago and all the renovations are already done, and now we're in the process of leasing it all up. Over the course of the next probably 8 months, we'll have it fully leased up, at least enough to where we can go back to the banks and refinance it at a higher value. So when we're at about 85% occupancy at this, it will generate $135,000 of net operating income. That means at our cost basis of $1.15 million, this property will generate us a cap rate of 11.8%. There's no deals out there. I bought this 2 months ago, and at our cost basis will generate us an 11.8% cap rate in North Carolina, a very, very strong market, solid B-class kind of an area. That'll put the stabilized value on this at $2.26 million. Again, we're only into it for $1.15 million. That means we've generated and created equity equal to $1,110,000. What does that mean? Well, what's the next step? Once we have it stabilized and once we go back to the banks and refinance it, they're going to give us a loan amount at $1.7 million. When we go to the bank and get a new loan at $1.7 million, we take that $1.7 million, we pay off our acquisition loan, we pay off our equity investors, and then we put $550,000 of non-taxable refinance proceeds in our pocket. We'll carve that up amongst our equity investors, the joint venture partner, and then our team as well. And then this property will still cash flow over $26,000 per year after all operating expenses, after all debt service. That's $26,000 of cash flow in our pocket on an annual basis as principal gets paid down, as the property appreciates over time, and after we've already taken $550,000 of tax-free money off the table. That is how legacy wealth is built. Hey, I wanted to share a 105-unit apartment building that I'm closing on 2 days from now. We're actually wiring the funds, signing all the paperwork today, and everything is transferring with the title company in 2 days from now. So let's dive into this and go over some of the numbers. This is 105 units we found in Louisiana. Actually came from a student that came out to Commercial Empire and about 12 months ago. He's been working for deals, trying to find the right deals that we can partner up on. He's really good at finding deals, just doesn't maybe have the balance sheet to qualify for the loan, maybe doesn't have the access to capital for the down payment, and wants somebody to hold his hand through the entire process to ensure that he doesn't trip and fall and mess up on his first deal. So he brought us this 105-unit apartment building in a B-plus area of Louisiana, and wanted us to sponsor the loan, wanted us to bring the equity, the down payment money, and wanted us to just help hold his hand through this whole process. So he's going to oversee all the project management and be kind of our boots on the ground partner, along with third-party property management there on site. It's a big renovation. We're buying the property, which is already 90% occupied, so it's in good shape. It's just very, very dated. So we're buying the property for $4,278,000, and we're putting nearly $2 million, $1,949,000 of work into the property. That's because it's just very dated and they're very big units. The average unit size on these is 700 for the smallest efficiency apartment, 700 square feet, and the 2 bedrooms and 3 bedrooms go up to 1,300 square feet in this area. So there's big units. It's not a lot of work that needs to be done. It's all the basics, it's paint, flooring, and fixtures. It's just a lot of it, right? We're doing roofs and a lot of cosmetics, exterior improvements, interior common areas, landscaping, all those different kinds of things. It's going to be pretty much a new building when we're all said and done. So we're buying it for $4.278 million. We're putting $1.95 million worth of work into it. There's some closing costs, carrying costs of around $267,000, which puts our all-in cost, our cost basis in this property, at $6,495,000. We'll have this thing stabilized in right around 9 months and be ready to refinance it right at the 12 to 13 month range. Here's what the net operating income and the stabilized financials look like. The net operating income on this will be $657,000. At our cost basis of $6,495,000, that gives us a cap rate of 10.1% in a market where everybody says it's overheated. Everybody says it's over the top and you can't find deals. We're buying properties this week at a 10.1%. That's going to yield us a 10.1% cap rate at our cost basis. Deals are out there if you're willing to go off market, if you're willing to go direct to the seller, and if you're willing to roll up your sleeves and get your hands dirty a little bit. You got to be willing to do the value add improvements in order to make these deals work. So at the new net operating income, that'll put our stabilized value, the stabilized or the after repair value on this, at $9.4 million. That means we created $2,905,000 of equity in less than 12 months in an apartment building in today's market. So I promise you there's deals out there. I promise you that there are great deals out there, and you can build a lot of net worth and a lot of equity in these projects, even in today's market. So on the new valuation of $9.4 million, we'll get a new loan amount of just over $7 million. So $7,050,000 is kind of what we're projecting. That means we'll be able to take that $7,050,000, pay back our equity investors, pay off our acquisition loan, and carve up non-taxable refinance proceeds of $555,000 amongst my team, the joint venture partners, and our equity investors. This property, even with the new loan amount, will be able to cover all the operating expenses. The rental income will be able to cover all the operating expenses, cover all the debt service, and still generate annual cash flow of over $200,000 a year. $203,567 to be exact. That is how legacy wealth is built. Hey, I want to share another case study with you. This is a 48-unit apartment building just outside of Cleveland, Ohio, my hometown, that came across, actually a local joint venture partner came across this deal through their residential wholesaling efforts. So they're a residential wholesaler, but the thing is residential flippers and residential real estate investors still come across commercial real estate deals. They just don't know what to do with them typically. So this is a local joint venture partner of mine. He brought this deal to me, didn't know how to underwrite it, didn't know how to operate it, and brought it to me and said, hey, I found this deal. I'd love to be a part of it. I want to scale into apartment buildings. Can we joint venture on this? I said, absolutely. So let's dive into the numbers. It's a 48-unit apartment building in a suburb that's probably a B- type suburb of Cleveland, Ohio. And we were able to buy the property for $1.47 million. The renovation budget that we originally projected was $429,000. We actually overborrowed a little bit on this. So we thought we'd be all in for around $1.9 million. We're actually all in for just over $2 million, about $2,050,000 on this one. There were a couple things we decided to do after the fact, and then some plumbing stuff that popped up that we didn't expect. And so we're all in for just over $2 million on this project. The stabilized numbers, we bought this about 18 months ago. The stabilized numbers on this are around $251,000 of net operating income. That means on this property, we are at over a 12% cap rate on a building that we bought just 18 months ago. The stabilized valuation on this property is $3,585,000 at its new net operating income. So that means we've created equity in this of over $1.5 million in just 18 months. So here's how this is going to play out. We're in the process of refinancing this right now. We'll get an 80% loan for around $2,868,000. With that, we pay off the $2,050,000 that we're into the property for, and we put $818,000 of non-taxable refinance proceeds in our pocket. We'll distribute that amongst the joint venture partner, our team, the equity investors that are involved in that project. And even after we take $800,000 off the table tax-free, the property still cash flows $66,000 per year after all operating expenses, after all debt service payments are made. It generates over $5,500 a month every single month as we hang on to this property on an ongoing basis. Over time, the property will appreciate. Over time, the principal amount will be paid down. And over time, 30 years from now, we'll own this property free and clear, and it'll be worth probably double what the current value is. It'll be worth over $7 million. We'll have zero debt on the property 30 years from now. That is how legacy wealth is built. Listen, I'm a kid from Parma, Ohio, a blue-collar suburb of Cleveland. My dad was a police officer. My mom was a stay-at-home mom. I don't come from long-term family wealth. I didn't go to some Ivy League school, and I never took a class or even read a book on this stuff. It's from real-world experience that I'm teaching you. I've gone through the entire gamut from A to Z of apartment investing. Everything you could possibly think of, I've been through. And I want to convey that information to you, and I want to make sure that you don't make the same mistakes that I made and fast track you to success. Click the link, get the video, I'll see you on the other side. Over the next 60 seconds, I'm going to debunk the 3 biggest myths in real estate investing. Myth number 1, you need to come from money. I'm a blue-collar kid from outside of Cleveland, Ohio. My dad was a cop, my mom was a stay-at-home mom. I didn't come from money. I'd never been to an Ivy League school, and I've never taken any of these classes or courses or read a book on this stuff. I've all learned it through the school of hard knocks. Myth number 2, there's no more good deals out there. Over the past 4.5 years, every single property that I've purchased has yielded at least a 9.5 to about a 17% cap rate at my cost basis in this current market. Myth number 3, it's a bad time to buy. If you're paying retail price, absolutely that's the case. But if you're finding off-market direct-to-seller deals and you can negotiate a wholesale price, you can absolutely buy commercial real estate in today's market and create long-term legacy wealth with it. I buy apartment buildings in A and B class areas. When the market's up, everybody can afford those types of apartments. When the market shifts, all those luxury renters move into more of an A and B class workforce type housing. So I stick to apartment buildings, I stick to A and B class type areas. I buy at wholesale deals. Essentially every single apartment building I'm into, I'm all in purchase price, renovation costs, and holding costs for 65% of the stabilized value. So if this is something you want to learn more about, click on the link on this page, and that way you can get instant access to case studies, deals that I've done in the past 12 to 24 months that I break down all the financials, where we found the deal, how we structured it with private money, how we structured it with our joint venture partners, how we actively did the value add process and the project management, paired it up with property management, turned around and refinanced it, and what all the economics looked like in that entire case study. So click the link below. Let's get started now.